ultimately, if you don't understand why you're buying or selling something and you can't explain it other than a chart pattern, then you're doing it wrong. And I think a lot of people just fail to understand what fundamentals means.
Welcome everyone, today I'm sitting down with Samuel Leach. We spoke a while back. Samuel is a trader who has a really good transparency and someone who's able to kind of explain things in a really good way. So Samuel, good to connect with you again. Welcome back on the podcast. Looking forward to discuss again.
Thanks for having me. Good to be back.
Awesome. So tell me, I think it's been, 2 years since we last spoke? I believe it was before COVID. Tell me what's been going on since those past 2 years, kind of what you're working on right now.
So I suppose the biggest thing I think for us was, I think during COVID, I think they got this whole bombardment of funded accounts and lots of them going bust, going broke. So I think for us, it was sort of, making sure that we explained in the sector the healthy way, I suppose, of trading in a risk managed method. As well as also trying to create a different approach to the sector of helping traders become employed. And that's probably been one of our main focuses during, I'd say, over the last 2 years. We've been doing a huge amount of work where we're now in a position now where we are educating individuals to get their level 5 diploma, which in the UK is equivalent to a foundation degree diploma. And then also a level 7, which is equivalent to a master's degree. In the UK, when we sort of look back at history, 1940s, 1950s, having a degree, there was only 1% of the UK population had a degree. Now, 40% of the population have a degree. So getting that next step now, which is a master's or a master's equivalent, is now putting you into that 1% bracket. So we really wanted to sort of, help traders not just learn to trade, but also learn an employed skill that they can go and take on and get recruited from that. So I suppose that's probably been my biggest focus. We've made some really strong headway on that and been able to offer our level 5 and level 7 diplomas. And also it's nice to see the banking industry start to change. We only had, I think it was this month, where I was doing an interview of Daily Mail. Santander basically have said that there's the space now to get into banking and into finance and trading is so competitive that they're now lowering the grades that they want, or looking at equivalent gradings outside of the degrees, which would be diplomas. So it's been a nice journey of being able to help those individuals now. And so this year we've basically got our first foundation degree, a master's degree training, which is going to be awesome. And it's Ofqual regulated by the UK government as well. So it's exactly the same as you going to university and getting a degree, but in financial trading. So it's nice to be able to bring the passion to a structured system where people can pretty much go and get that skill, really.
Interesting. Now, I suppose if that's like a master, it's definitely a lot of work into it. You got to put a lot of effort for sure. What's the benefit of getting a degree? Is it just being able to get it hired by a bank or like a big firm, or what exactly are people trying to do with the degree in the financial markets?
Yeah, I suppose the interesting part about it is when you go to a traditional university, you look at the fees now, it's like, 40 or £1,000 to go to UK university. Then you've got your masters, which is like another 10 or 20,000. So before you know it, including accommodation fees, you could be at over £60,000 in debt just to go and get a job. It was really interesting because I think like the younger generations now have started to change. They don't want to go out and go to university, go get drunk for 2-3 days of the week and be in class for 3 or 4 hours over 2 days. And the rest of it is just going out and partying, basically. So we basically wanted to challenge the status quo, and we, reached out and basically said, when you look at a foundation degree, it's like 360 study hours. Why are we doing that over such a long period of time? If we actually crunched that down and we condensed it and we did 8 hours a day, we could achieve a foundation degree in 12 weeks. Now, when you think about that, it's like, it's exactly the same study time, exactly the same equivalent qualification by the exact same government body. and we can achieve it in 12 weeks. So we managed to get them to agree to the scheme of works over 12 weeks to produce that over 8 hours a day. So I suppose the benefit off the back of that is, I think a lot of people these days, if you talk to people, I did a poll on my Instagram the other day, who uses fundamentals in trading, whether it be stocks or FX. And some people was actually messaging me like, what's fundamentals? Like, it's crazy that people don't understand what fundamentals are, but they're risking their hard-earned money in the markets. And it's like, you know, having this sort of layout is fantastic, because obviously if you're going to do a level 5 diploma, for example, you're going to understand sort of what's gold got to do with the economy. How does that factor into anything? What happened during COVID to the markets? It gives people like a broader economic understanding of what's actually going on behind currency moves, behind indice moves, things like that. And I think that's the foundation that people should start in, rather than going, right, let me go and trade this pattern trading or something without looking at any fundamentals. And I think breaking it down from a core economic point of view first, and then trading throughout that, makes a lot more logical sense. You know, I always use the analogy, it's like going to the hairdressers and you just basically saying, pass me the scissors, let me cut my own hair, sort of thing, rather than actually studying how to do it right. You know, it's not necessarily going to take you a long period of time, but you need to know exactly the right way of doing it. And I think, you know, it's nice to be able to hopefully save people a lot of money at university, that want to just basically go shortcut it, condense all of that learning, learn the right things, but get the same qualification and get out into the job market quicker. You know, working, you know, with a level 7 diploma, you can go off and work in a brokerage. You can go work off in finance firm, financial advisory, get into that entry level roles. You can go into banking roles. And it's overall, it's a nice thing to have on your CV, I suppose.
Interesting stuff. Yeah, it's a different perspective from what I've heard before. And I guess the issue when you get a normal degree is the fact that you kind of have sometimes a tough time to find a job because there's so many people doing the same thing, or the fact that you have a very like entry level job when you start in a firm. That could be different, and trading could be something different because, of course, traders are always kind of researching. Like you said, the firms are lacking enough people to fill these roles. That's a good thing, of course. What can people expect when they kind of finish graduating with a financial markets degree? Can they kind of have already a job offer for them waiting for them, or do they have to kind of prospect and find different companies that could hire them?
Yeah, no, it's a great question. I won't name which banks we've been talking to, but we've been talking to quite a few banks, and we're actually looking to line up entry-level roles, basically directly from our diplomas straight into the bank. So we're trying to do that whole shortcutting work for those individuals that are actually sat there looking for jobs and prospecting. We're trying to fill that gap for them. And it looks really promising. It looks like we've pretty much filled a couple. So yeah, exciting times. At the moment, it'd be exactly the same as when you've got a degree. You'd go out and you'd apply for your job, so on and so forth, and go down that route. But we're looking to bridge that gap for them and basically say, look, if you come through, you get your level 5, you get your level 7. At the end of it, you've got this role waiting for you at this bank. We can get them through the door, get them into an interview, and the rest is over to them to basically show the bank that they're the right candidate. But I think, you know, you look at what you're learning at university now, and you're learning about theories from like the 1960s. You know, it's really old, outdated information. And we just basically going, here's modern information in a condensed time with the exact outcome that you want to get at the back of it. So no, it's been really exciting. It's been taking a lot of time to get to where we are, to be able to do it, to become an accredited centre, to be able to go get the diplomas, have all the right staffing for it, absolutely everything. But yeah, what a great journey. And it's just, hopefully it's going to combat a lot of the, how to put it, signal providers, a sector of people, you know, losing loads of money in signal providers, and also people going and, I would say, you know, being cautious about going for the right funded account, I suppose, if you're going to go for funded accounts at all.
How's been your trading through all of the past 2 years? Because you're doing a lot of stuff on the side, which is awesome. And I kind of imagine it's a bit harder to kind of focus on trading at the same time. So how's been that going for you in the past few years?
Yeah, definitely. Yeah, I've been trading. One of my biggest trades was on oil during the pandemic. That was probably one of my main focus. I suppose my focus shifted from FX trading to stocks when the COVID crash happened and you saw stocks down 30, 40%, sometimes even more, some at 50%. And basically being able to buy up discounted great companies during the pandemic pretty much. Also predicting those that were going to go and rally off the back of pandemic happening. Prime example, Amazon deliveries for food is going up. Zoom obviously is now one of the big things off the back of the pandemic. But I would say, my biggest trade was oil. I was a bit cautious, even though I've been trading now for well over 10 years. I've never in my career ever seen oil prices go negative. So at the time, I was sort of cautious because I was like, well, it's at $4 now. It's come back to positive. But I was sitting there thinking, what happens? What happens when it goes negative? There's no one to really ask because it's never really happened before. So does that mean my position goes negative, or does it stop going negative at zero? Because that way I really can't calculate my risk management if I'm going to go into this position. So I found that quite difficult. Whereas also for you, obviously you'll know, but the holding fees for oil on a day-to-day basis, week by week, can accrue quite aggressively, and it actually really sort of lowers your profit margins from holding it over a long period of time. So I wanted to look at like a calculated way of, well, we know we're not going to be in lockdown forever. Oil prices are definitely going to go back up. How far they go back up, who knows? Everyone's talking about fear and everything else at the moment. So I decided to buy oil at $8, but I bought it on an ETF. So I bought it on that knowing that the fees were going to be out of the way of the ETF. I didn't need to worry about daily rollovers, weekly rollovers, any of that information. And basically sat there, and literally within 2 to 3 weeks, it went from $8 all the way up to $30. And that was one of my big trades. Great percentage return, obviously, from that. Hindsight, great thing. Would have loved to held it. Could have held it to 120 and been on an absolute holiday. But yeah, in general, it was all about, at the time, it was very much in the moment. It's very different to looking in hindsight. I was sitting, we could hit $30, but now they're talking about a second round of lockdowns. So does that mean we're now going to go negative again? And is all that profit going to be erased? So I was like, maybe it will. Let's just get out at 30. Done a great percentage return here. See if it goes back down, jump back in again. Obviously it didn't, but yeah.
So this is the thing that people don't understand too much about trading sometimes in the beginning. They think, oh, well, you just got to buy when it's low, and then you sell when it's high. When things go really bad, you're just going to buy a lot of it, then you're going to sell, make a ton of money, like kind of the way you did it. But when you're in the moment there, it's a lot tougher to think about those things, right? You're going to think, oh, you're going to be afraid, you're not going to want to jump in, you're going to want to wait more, then you miss out on the move after. So what do you think is it that makes you want to get in the trade at that point compared to someone else who just cannot kind of force themselves to get in that kind of trade?
I mean, to be honest with you, I'm a very straightforward thinker, and I think it's common sense to know that are humans going to go back out that front door from lockdown? The answer is yes. Okay, so the only variable that we didn't know was when. Could I take some pain on an ETF to a downside? Yes. I calculated my risk based on no leverage whatsoever. So it went to zero. I was completely comfortable with that. That was what my risk was over. So when you look at it from that point of view, I was very comfortable in that scenario taking it. It was more, how long is it going to take for my position to get to an area of comfort? Also, there's a bit of a lag on an ETF. So the ETF lags based off of it tracking the price of oil. So we still have that to factor into that trade. But overall, it was a very common sense trade. It was like, okay, when will the cost of storing a barrel of oil go down in comparison to the price of the actual barrel itself, the value of the oil? And that was basically the trade, and it never happened in history. So I was like, well, it's not going to last forever, because we're going to have to get back out on the roads. We're going to have to go back out and get back to work at some point, whether it's now or in a year's time. I'm comfortable being able to factor that risk in and go and hold that. So that was one of the best trades for me during the pandemic. I also got another great one as well, which was Brighton Pier, which I actually can't believe it's even a stock, if I'm honest with you. Those that don't know, if your listeners are outside of the UK, Brighton Pier is literally a pier in a coastal town on the UK that's listed on the stock market. was sitting there thinking, everyone was talking about how no one's going to be going abroad for a long period of time now. And staycations is the next big thing. So I was like, well, where is the first place people are going to? A lot of pubs are closed, but a lot of people are going to go to seaside resorts. And it was literally Brighton Pier was on there. What was really interesting when we was doing the background research into it, George Soros was one of the biggest shareholders of Brighton Pier. And I was like, what? Why would George Soros owning a percentage of Brighton Pier? I was like, well, one, that's a great thing because we've got a really big sort of whale behind us as an investor into Brighton Pier. And I also thought, where are people going to go? They're going to go to Brighton. They're going to want to go out on the pier. They're going to go out and want to eat at the restaurants, and they're going to go and drink. And obviously, it was one of the most battered shares that there was because obviously all the restaurants got shut down. So that again for me was a great trade. I think it went from, off the top of my head now, you're going to test me, but I think it was in from around 24 and it went all the way up to 69.70. So that was another fantastic trade, especially during the pandemic. So there's a few like that that we saw. So those were the two main buys that I had throughout that period of time. And ultimately, these were sort of, how would I call it? I call them like black swan events, especially oil going negative, I'd say is a black swan event. And I would also say that COVID and the pandemic in itself was a black swan event. So those two are the main ones. There was also a REIT called Commercial Property Trust. And it was basically a whole stock that had hundreds of commercial properties wrapped underneath the stock. And when I realized that everyone was saying, it's time to go home, don't go to the office, things like that, I knew it wasn't going to be long. Most people say that keep 3 months or month-to-month savings to see you buy in a bad time sort of thing, don't they? But I think there was a stat out the other day. It was like 1 in 3 Americans have like $400 in savings or something along those lines. It's like ridiculous. So when you think about that, I knew it wasn't going to be long until people started defaulting on paying their commercial rent. And ultimately that was going to affect the whole company that's basically profits is based off of collecting that rent. So I short sold into that stock, and that was a great stock that went down by about 40-50% and benefited off of the back of that as well.
Those are kind of major events that we're not going to have necessarily every year. They're kind of big situations, especially COVID and stuff around it. How is it that you make money on a normal basis with like fairly normal markets? Are there some things you look at? What's kind of like your primary or preferred trading style?
I mean, like you're saying, because I've been doing so much stuff, rather than sitting there trading FX intraday, how my schedule looks is like, ultimately on FX, I try to target 4 to 5% a month. If I can see an opportunity in equities that's going to outweigh that 4 to 5%, but I don't have to sit there every day, then I'm saving on my time. So my strategy switches between focus on equities if they look attractive and I can see the gains there. And if they don't, when markets are at all-time highs, for example, before, I'd say after COVID, when we had all of the stimulus just getting pumped into the markets and we saw markets highs, I was like, I'm not buying this here. We're ridiculous levels. And that's when my focus was on FX intraday. So on a day-to-day, like now, I'd actually say that the value proposition is back into equities. We're seeing the S&P down reasonable well. I still think we could go lower. Lots of factors around that with Russia and obviously Ukraine. And then you've got the whole recession side of things. There's talking about this soft landing. We've got increased inflation, high interest rates, and those interest rates are looking to stay stably high for this entire period of the year. So you're going to start seeing slow growth, if any growth. And with that becomes sort of opportunity. You're already starting to see that. And I hate to say it, but, Tesla, for example, when that hit 100, that for me looks very attractive. Whether it looks attractive right now, I don't see it going much lower than that. But in the long term, I easily see that going back up, 200, 300. When you think about that, let's just factor that in. Let's just say it goes from 100 to 200. Let's just say that takes 2 years to go and do that. Well, when we look at that, that's 50% a year growth on that stock. So when I weigh up my time, effort, and energy that's been put into achieving a 4 or 5% monthly gain to having one stock in that scenario, just one trade, planning out that whole period, it makes sense to take advantage of when equities are cheap. And there's lots of stocks like that right now that are trading at good value, have got a good outlook on them. And there's just everybody's reining in their purses at the moment whilst there's the whole recession talk and things like that. So we're seeing some great value in companies.
Are you using the same methods for Forex that you do in stocks? Or I feel like there's maybe a bit more fundamentals into the stocks and less into Forex, or is that mistaken?
Everything I do is always from a fundamentals outlook anyway. So, for example, with FX, what I will do is I will be looking at what's the bank's outlooks. So where do the banks plan on the currencies, major pairs, pound dollar, euro dollar, US dollar, yen? Where is their 6-month outlook? Where's their 12-month outlook? Because usually they're right. Yeah. So I focus on that side because I always want to be doing what the banks are doing, what their aim is, what their target is. Whether they're right in the distance that currency is going to move is a different matter. Just knowing the direction that they're looking for is like, okay, this is where price is. This is where they're predicting it to be. They're on a buy side for this for the next 6 months. That's nice. So I look from a fundamental point of view. Then I take into account daily and weekly news releases. So anything, like we're talking about non-farm payroll, CPI, anything like that. I want to take that into account as well to see if the economy is either shrinking or growing. And then I go down to a technical level. Is the daily aligning with the bank's outlooks, the fundamental outlooks? And then when I trade intraday, I'm trading in the direction of the bank's outlooks as long as everything is aligning technically. So technicals for me is actually the smallest chunk of what I'm actually doing. I want to focus where the banks are moving the markets. And then on the flip side, when we look at stocks, that's a different conversation in itself. But stocks are basically, you don't need to look at a wider picture of what's going on. I mean, you kind of do if you're looking at retail stocks, for example, like ASOS or Boohoo, things like that, where consumer price index is going to pay a big sort of factor into their returns and results. But ultimately, on a normal stock, for example, a tech stock, you're just looking from a general economic outlook of, does this stock factor in how the economy is looking? Are they making good earnings at this moment in time? What is their profit to earnings ratio? I also use what Benjamin Graham, if you know, the investor Benjamin Graham created fair value and basically factoring in the mathematical equation of, is this company right now, if we was to take it off of the stock market at the price that it is right now on its market cap, if we were to liquidate all of its assets, liabilities, and have all the cash in the bank, would it be worth more than what it is on the market? And if that is the case, then I'm basically buying that stock at discount. So there's other factors that go into it, but from a high level, that's what we're looking at to basically take advantage of those positions. I mean, the stocks that are probably getting hounded now are those that aren't profitable. It's very hard to decide what is a market cap for a stock when it's not making profit. So you find that those stocks get hit harder than those that actually have a profit bottom line, basically.
Feels like fundamental analysis is sort of less popular these days than it used to be before. People are much less into it now than they were before. They prefer charts. Charts might be more sexy, perhaps, or there's something to it where people don't really like to look at fundamentals, do the math like you do. Do you think that gives you an edge you wouldn't get from the charts only?
You can't see any of that in the charts. I'm a big critic for it. I used to work in one of the leading independent private banks in the UK, and I mean, when you hear some of these technical strategies that people talk about that are on YouTube, it is quite laughable actually when you see it, especially this whole sort of, block trading and things like that. That's actually quite laughable to institutional traders. You can't see block trading on retail broker platforms. It's physically impossible because all you're seeing is your broker's liquidity. You're not seeing bank liquidity. And most block trades are actually done out of market hours anyway. So it's not something you can see. I mean, the thing behind it is they're actually highlighting supply, just general support levels, and then they're creating this whole, meaning behind it that's not actually there. So it's quite interesting because obviously when you're looking at bank flow and bank liquidity, You can't see that on a retail brokerage. You can't see that.
Yeah, the aspect of trading like a bank has been very popular the past few years, learning to trade like these bank trades, but they have different goals, they have different methods for sure, and they have different platform like you said, so definitely far from there. But yeah.
Yeah, no, and to be honest with you, it's something that, like I said, needs to be spoken about more because I feel like a lot of people get wrapped up into charts, charts, charts. You'd be surprised at how little banks look at charts in regards to criteria to enter the markets. I mean, if you think about it, could you imagine someone that's, getting paid sort of like 150, 200,000 pounds a year, right, in the bank, going to their line manager saying, we need to buy up pound dollar right now because it's got a double bottom. Could you imagine that? Why would they pay anybody 150, 200,000 pounds to be able to identify a chart pattern that a 5-year-old could identify? It doesn't work like that. In the great scheme of how people think it works, it doesn't work like that. People need to take a broader picture and get a 360 approach to the actual markets. Is there anything wrong with taking technicals into account? Absolutely not. But it shouldn't be your first point of interest that you focus on in the markets.
What would be advice to people who don't have a strategy and want to create something to start trading it? What would you have them to focus on? Is it more fundamentals first? Is it a mix of both? Where can they start to kind of see what works for them and what doesn't work too well?
I mean, look, I won't sit here and go and plug my own diplomas and things like that, but it's pretty much what I created them for, is so people can learn the right way. I think that's a big problem in this sector. There's so much education out there from people that either aren't accredited, have never had any experience working in banks, or have actually never really traded properly themselves. So, trying to get rid of all of that out of this sector, which is pretty much a really horrible name for the sector, and actually go, do you know what? Here is government regulated training. This is basically what I want to do. Is I want to try to tidy the sector so that it makes everything a lot cleaner, and puts people in a right place to be able to do that. Where should people start? If I was to take myself out of the picture and go, what am I doing now? Don't go near me at Samuel Co. I would say probably look at CISI, look at the Chartered Institute of Securities and Investments. I'll probably go down that route, which is a professional route that's noticed by the banks. Go get it's quite expensive, but go get the learning material for it. Another one would be probably look at investment management certificates, IMCs, and go down that route of learning the true understanding of markets from an economic point of view, rather than looking at charts. And I think, to be honest with you, a lot of people are going to always opt for charts. It's the easiest option. It's lazy. It's there's no research needed for it. You just go onto YouTube and type in successful chart patterns. And you see a load of stuff that's on there. But ultimately, if you don't understand why you're buying or selling something and you can't explain it other than a chart pattern, then you're doing it wrong. And I think a lot of people just fail to understand what fundamentals mean. So going down these professional routes of learning that anybody can do is the right way of doing it. If you're going to do anything, you should do it the right way rather than cutting corners, just jumping on charts, things like that. It should be, how do I learn this from an economic point of view? Once I've learned it from an economic point of view, how do I now capitalize on that? As I was talking about earlier, once you've understood the theory, you shouldn't even be putting real money in the markets. You should be understanding, do I understand the theory? Do I understand the concept behind this? Okay, cool. Cut demo accounts. Let's not even go to demo accounts. Pointless. You don't get the same mental understanding or sort of processes of risking real money. The most simplest way to go forward is go open what you call a cent account, which is where you can trade literally like pennies, and you probably lose more money down the back of your sofa than you would on your cent account. And I would then apply your theory and your understanding to the markets in a live environment, but with virtually no money getting risk except for pennies. Get a good understanding, become confident in that, get some familiarity with that. And then if you are comfortable, maybe look at getting a live funded account, for example. Maybe look at then risking your own capital from that, or the profits from the live funded account, into your scenario, and double down on the growth. That's probably what I'd say is the right way.
Interesting. That makes a lot of sense. Now, I'm just curious. Let me take the other side of your argument for fun, for sake of discussion here. What about someone who says, well, I don't care if I'm getting hired by a bank. I just want to trade on my own, have my own capital, and I don't really care for these like fundamentals or things that the banks use. I just want to kind of trade on my own account and do my own thing, maybe travel, maybe have freedom. Would it still make sense for them to kind of learn fundamentals and learn the way you do it, or can they just go and learn different things?
I would argue that I've never met a trader that's successful from just technical trading, and I would argue that quite openly. Like I said to you, it's like trading something without the full picture. It's like buying Tesla because you like electric cars. That's literally like that. You know, there's nothing wrong with that, but don't get upset if you're not consistently profitable at picking other vehicles, other stocks. You know, it's the same. It's the same approach. If you're doing it because you just want to have a bit of fun, that's completely different. If you want to be a success at it and do it so that you can have sort of a freer life, you're in for a hard shock unless you're, you know, doing other things. It's going to take you a while to be able to get to a reasonable size, especially in European countries. You know, do I know some guys that have been successful trading that have moved to Asia, Thailand, Malaysia? Yeah, of course I do. Cost of living's a lot cheaper there, and it's a lovely place to live, and it's you know, Bali is nice and efficient. The perfect goals. But in Western world, you know, you've got the emotional highs, you've got a mortgage, you've got car finance, you've got your cost of living, the costs are a lot higher. So unless you've got reasonable sized capital to be able to trade without the stress of chasing trades and making errors based off of your need for money, you know, then you're in an okay scenario. But if you are looking to try to survive solely off of that for 5,000 or something like that, you're not going to be in that scenario. And, you know, I'm quite passionate about that. And that's when we created a YouTube series, literally all about, it's called the Real Forex Trader Series. And we had thousands of applicants from around the world, no trading experience whatsoever. And we took like 15 candidates and we threw them into the deep end. It was like, right, these are you're going to go through all these crazy challenges. We're going to give you live accounts. You're going to be on the trade floor. Let's see if you sink or swim. And we've got another series that comes out in April where we filmed it with 13 individuals, and it's been really cool. It's been a really interesting series. Like, how do we put them in stressful environments that would replicate if I was in a big loss? How do we put them through, for example, a 24-hour trading challenge? Why should we put them through a 24-hour trading challenge? That's not realistic. I would only do an hour a day. Well, not really, because if you was actually trading properly, let's be honest, if you have general elections, presidential elections, you're pretty much pulling all-nighters. So let's show them what that feels like. Let's give them a real taste of what it's like on the trade floor. So we put them through all of those scenarios, and then we say, here's £2,000. We now want you to go and trade that £2,000, go and make as much money as you possibly can. You've got to live off of it, eat off of it, and travel to this destination on it. The first trader that gets there is the winner. And that's what we do. And you see how people either make a lot of money, usually from high risk trading and risking it all. And you see people that lose it and are, you know, begging at a train station for a croissant because they haven't eaten in a day. But it's an interesting YouTube series, and I think it was quite fun filming it as well to document. You see the highs and lows, you see tears, you see happiness, you see people make good money, you see people lose money, and also how they deal with that as well. So yeah, I don't think it's possible, in my experience, like I said, I've been doing it for over 10 years, to sit there and just trade technical. You might get lucky, I suppose, for 6 to 8 months if you get a trending market and you're just simply buying the dips and going. But as soon as you hit like August, where it's range bound, December, where it's range bound from people been on holiday, taking time out of the markets, and I'm talking professionals taking time out of the markets, you see that directly in the currencies, you see how the behavior changes. And why aren't you paying attention to that person that's causing the markets to change when they're not there? That's what you need to focus on.
I think the issue where people kind of go wrong with technicals is that they kind of rely too much on setups, like say the patterns or the engulfing candles, this and that, the setups, while not looking at a bigger picture in the market context, like how overall it's looking, how price is moving, how the patterns are. I think volatility is also a big aspect there. People want to look at. So I'd say you can make it work. I know plenty of people who do it and manage also some funds around it. But it's definitely something you gotta kind of look at a bigger picture, not just like a setup or an entry pattern necessarily by itself.
Yeah, I also think you got nothing to lose by looking at the bigger picture.
Right, for sure. No, for sure. Yeah. So we got to talk about a little bit about prop firms, because prop firms are getting popular these days for sure. There's been a lot of them opening up in the past few years. What do you think is coming up for this industry of the prop firm trading? More going to come for forever, or do you think it's going to kind of die out over time? Or what do you think is going to stand out from there?
I'm going to tread on a lot of people's toes with it. I think that a lot of it shouldn't be happening. Okay, give me an example. Okay, so at Samuel Co, you can trade a live account. Our rules are very simple. You trade 1% risk, and you can have a max drawdown of 30%. Okay. Now, most of these prop funds will have max drawdown of 5%. Yeah. And it's usually off of the high as well. It's not even off of your account. So if you made a bit of money, you'd then have a 5% max drawdown. Okay, well, like I said, I've traded for over 10 years. I know a lot of people in the professional space. I've never met any trader in the entire world that's not had a 5% drawdown, which basically means that the whole design of a prop fund is basically to take the money from an evaluation, yeah, get the money in the bank and move on, because overall, there's virtually no one. Even if you look at an index, let's take the S&P 500, yeah, it's literally diversified across 500 companies. That can hit, 20, 30% in a drawdown. Especially when you look at retail traders, I've hit a 5% drawdown. I've hit a 10% drawdown. I've hit a 15% drawdown. I've even hit a 20% drawdown. So there's so many prop firms out there, and there's huge evidence behind it. I can send you an article behind it that was released by the SEC, which basically documented how much traders win and lose based off of leverage. So all these prop funds will smash the leverage up. Yeah, 400 to 1, 1,000 to 1, you name it. They'll try to give it to you, because the higher the leverage, the more risk you have, the more likely you are to hit your 5% drawdown. The lower the leverage on the SEC stats based on their whole case study, the more profitable that the traders are. So it's like there's so much out there that's encouraging people to come into the markets, which isn't a bad thing. It's just done in the wrong way. Why promote something where no trader that you've ever met or ever know is ever capable of maintaining that account? It doesn't make any logistical sense, and they just end up losing the account, and then they're back at square one, and they've got to pay the money again and go again. So we try to combat that as well in the sector. We offer 1 to 3 leverage, which is low risk leverage, and a max drawdown of 30%. So basically account and equate for that, and to give people a fair chance in the markets with good risk management. But what's the point in giving someone 400 to 1 leverage but a max drawdown of 5%? It doesn't make any sense. You're going to say, okay, but that doesn't matter. They can risk 0.1%. Well, what's the point in having the leverage or the huge account size if you can't risk the money that you want to risk? It doesn't make any sense.
Right. Do you feel like the leverage is an issue? People don't understand how to use the leverage, or because you don't have to necessarily use it yourself. You can just keep it on the side, not touch it, and just trade it a small size and still be good with it. Is it an issue where people want to get rich quick and they don't know how to use leverage properly, or it's just an aspect of it applies to everyone where you have high leverage, you're more likely to blow up the account?
Let's put it like this. We're at this moment at Samuel Co. We have got a 2-week free competition. Yeah, no one pays anything. Yeah, the top 4 will get funded. Okay. Now, on 1 to 3 leverage in 2 weeks, what do you think that the winner at this moment in time is performing at on 1 to 3 leverage?
Yeah, no more than a couple of percent. Yeah.
You think they're only up a couple percent?
Yeah.
Yeah, they're up over 15%.
It's pretty good.
Yeah, and arguably the top 100 are up over 2%. So that's in 2 weeks. Yeah. So in a month, hitting the 4%, which is a reasonable gain, achieving 50% a year with good risk management is what the goal should be. The problem is that people believe that having low leverage means that they can't make the gains. It's a load of rubbish. It's a load of rubbish. I've seen traders do amazing. You can achieve 50, 80% a year on 1 to 3 leverage. It's all about risking 1% per trade and keeping your risk there. Yes, you're right in saying, well, can't they risk 1% per trade with 400 to 1 leverage? Yes, they can do. Will they? Probably not. They'll take a couple of losses and go, right, I need to double down on this next one. And that's where greed comes into it, getting rich quick comes into it. And that's not going to create longevity. That's just going to cause you to blow your account and be back at square one. But regardless of the leverage, even if you had 1 to 3 leverage, if your max drawdown was 5%, you're still not going to succeed. That's the main point. And I think that's the one thing that really bothers me, is that there's a lot of prop funds there that are, beginners come in and go, do you know what? I don't want to risk my own money. I want to go into a prop firm. And then they get started and they don't truly understand what that means. And then it's like, you committed your money to it, you get your account, good job, great job. But you're going to hit that 5% max drawdown. Now my account's gone and I'm back at square one. It doesn't work like that. It's not something that can be maintained over a long period of time. And, we're big advocates for it. Samuel Co. is like, we have 1 to 3 leverage. We have all our account growth, 30% drawdown. Each month this is free access. You have free access to a mindset coach that will basically go through, how are you feeling? How's your mindset at the moment? Do you feel that that's had any effect on your performance this month? Is that what's factoring to your good performance this month? Is there anything I can help you with from a mental side for you? Then you've got a senior coach every single month. Let me sit down with you. Let me run through and review your trades. Okay, this trade was good. This trade was bad. What was you doing here? I don't really understand. And getting someone to actually look from the outside in, that's been doing this for years, given that coaching, or not even coaching, just having someone to rub shoulders with, who's in the same environment as you, that's wanting you to win. Ultimately, prop firms are wanting you to lose, and that's it's like being at a casino. It's the same thing. Arguably, I would say that I think when I run the maths, you actually have more chance of winning at a casino than you do on a prop firm that has 5% max drawdown.
I think things over time got a little bit easier. Of like the barrier to entry kind of got lowered quite a bit. Like when I was looking at funded accounts back when I was looking for more capital in my trading, the only thing you had was like these accounts you would pay like $5,000 and you would get an account with, let's say, 100K, but you had to cover your losses with your own 5,000. Which I think these days is a lot better because you don't have to put that $5,000 in the that you pay yourself directly. At the same time, the more people come in and kind of trade these prop firms, the more people will lose because the fact they don't understand the rules, or they're like low barrier to entry, people are getting to it faster and kind of losing more money there. So I agree, it's definitely a risk there because people can just take account after account after account and lose more money. At the same time, it's something that they have to also, if you're not learning how to do it right, then it doesn't make sense to just keep trying and keep getting these funded accounts forever. So,
it becomes sort of like addictive. I won't name any firms in particularly, but it's like, I've seen some people say to me, once I lost my account, they then sent me an email giving me 50% off to try again. And it was just like, keeping them hooked in like a gambling game. And it's just like, that's not how it should be done. We have meetings. If someone hits like a 10% drawdown, we're having a chat with you. What's going wrong? You're making a mistake. If you hit 30%, we're closing your account and we're not going to open it again. We want to know why you're doing that. Why aren't you following the rules? And if someone is bluntly not following the rules, see you later. We're doing this in a professional environment. And I think that's how it should be done. I think that, there's so many potential, I always see it like this. There's so many potential budding traders out there, could have gone far in the trading world, but got burnt straight away, whether it be from signals. Back in the day, it was binary options. Now it looks like, max drawdown 5% prop firms. If that's the case, now all of a sudden they're done. That's them. Their experience has been bad. They don't want to touch the markets. Whereas if you can do it in a controlled manner and you can do it in an environment that sets expectations, you're not going to make loads of money year one. But if you maintain this and you get good, could you make good money in 5 years? Yes. Okay, well, you need to make a decision then. Is it a career or is it going to a casino? That's what you need to make.
Yeah, definitely. I totally agree with that, for sure. I think prop firms are getting too close to casinos sometimes, and that can be an issue, but that's also the way people see them at the same time. Although you could argue the marketing is kind of set up that way also. So interesting stuff.
Yeah, I agree. The marketing is like that. And it's like, yeah, that's why I like what we're doing. I generally do. It's something that I'm proud of. It's not something that I'd go, oh yeah, I know that these guys are getting sort of fucked, you know. It's nothing like that. It's like, oh, we actually have people that come into us, they're learning good, they're leaving with good skill set, they're leaving with job potentials now, and they're leaving with, you know, live funded accounts with good rules, good support structure around that, with an environment where people can be around each other. And that's how it should be. That's how it should be. And it's a shame. It's a shame that it's not like that as an industry standard, but that's always going to be the case. But I don't know. I think regulators might try to clamp down on it pretty soon, I would have thought. But the only issue is regulators would, I suppose, struggle to clamp down on it because people aren't depositing their own money to lose it. They're paying a fee for the service, and that's what they're getting. So they're not actually they're not investing their own money, if that makes sense. So catch 22. But yeah, definitely a lot of these starting prop firms, unrealistic goals. It's a shame.
I agree. So when can people find you, don't connect with you, reach out after this podcast? Where can they learn your stuff, start to learn from you, and connect with you after?
SamuelCoTrading.com is probably the best place to find out more about what we do. Or my YouTube, if you're interested in watching that funny series. Don't get me wrong, it's educational series as well as been a bit of a laugh. The trailer comes out next week for it, which is youtube.com / Samuel Leach, or just Samuel Leach on Instagram. Any of those, really.
Awesome. Sounds good. So I'll definitely put links below the description of the video for check it out and connect with you there. I appreciate the advice you gave to people here. I think this has been a good discussion. We don't agree on all the same stuff here, but that's fine. It's good to kind of open the perspective, learn some more stuff from you. I appreciate that. And hopefully we can connect with you pretty soon in the future.